Are you in control? No. We don't want you to be in control, because if you're in control, a judge has control over you. So we want to be purely forward, because I want the offshore trustee. The assets are safe. That's a Supreme Court case. They tried to go after the wife 3 times. The husband stiffed the IRS for like 26 million, had a heart attack and died, put it in a Cook Island trust. And then they tried coming after her and she won, but then didn't settle the case. And then she kept taking out like $250,000 a pop and giving them to her kid. And then it kept opening the door for the IRS to come back after her and saying, you're obviously in control of this trust. You keep taking money out of the trust. You're not settling the case and you're giving it to your children. But even in a dumb situation like this, where she wouldn't settle and kept coming into the trust and taking out huge amounts of money at a time, they still couldn't hold her in civil contempt of court because the offshore trustee was still in play.
Now, on this podcast, we're going to be talking to Brian, who we've had on the podcast in the past. You guys asked, why don't we have all these speakers at the conferences? We don't do conferences because they're boring. We do more retreats, and you guys are the center of the attraction, interacting with each other as purely passive investors. Brian's going to talk a lot about entity structures and what do you do when you get a little bit higher on a net worth scale. What we're not talking about is where you need to bring in your estate planning attorney. And that's really where, all right, you have this irrevocable trust where you're getting money outside your state to stay below state and federal estate taxes. If you guys are under $5 million, $10 million net worth, maybe don't worry too much about it, because it'll probably change in the next 10, 20 years anyway. But if you guys are able to double your money consistently over 5 to 6 years, you do the math, right? A lot of people have come into the family office group at 2 million right now. In 10 years, you'll be at 2, 4, 8 million. And then in the next 5, 6 years after that, you'll be a decamillionaire plus, or what I'm calling in my book, the rooftop, where you can do whatever you want, or be complacent and be a lazy passive investor. Brian's a litigation attorney. That is more estate planning. And that's kind of thing that I'm personally working through. How much do I want to keep under my own personal stuff right now? Of course, protected under entities. And how much stuff do I want to put off to the side? Really protected outside my name. There is some headaches, as you just can't go and write yourself a check or write whatever a check. You have to act in the name of the trust, or however you work through things on your own. Because once you put it up into the cloud, it's gone. You've lost control of it. We'll bring on a guest on that in the future. That's why I always urge you guys, come out, meet us in person, have these conversations that we don't want to have on the public podcast. That is, you pay for what you get. It's free, right? But anyway, enjoy the show. Hey, what's up, folks? We've had Brian on the show. Brian Bradley, he's a lawyer. He works with a lot of high-end clients. And today what we wanted to do was to catch everybody up. In this next book, I'm really outlining what the normal real estate groupie, I call them real estate clubbers, like the non-accredited guys flipping houses do. And then obviously I've been talking a lot about what the wealthy do, right? 10 million plus. And that's why we brought Brian on today with the bridge trusts and offshore trusts. In the book, what I'm doing is really outlining the steps, right? For example, going into alternative investments. Your portfolio just doesn't change overnight. It takes several years, if not maybe 5 to 10 years, to really transform your traditional investments to alternative investments to get more passive income, and therefore passive losses, and then pay less taxes. And no different what we're talking about today, right? Legally, what are the steps transitioning from a broke real estate groupie to a accredited investor to a more senior accredited investor when your net worth starts to go past 5, 10 million net worth? And well, for those of you guys checking this out on the YouTube channel, no, Brian does not work for the mafia. He has a lumpy black eye. Why don't you tell us about it?
Yeah, thanks, Lane, for having me on. And no, I don't know if I represent people in the mafia or for cartels or not. I don't ask, but it's not for me getting roughed up. Part of my hobbies is I do jujitsu, and I went to a jujitsu tournament over the weekend, and I think I got either a knee or an elbow in the face during one of the rounds, which I ended up winning. The same. If you look at me, look at the other guy. He has no scratches on him. I just walked away with the gold. At least it's worth a little bit of the pain.
Real estate investor getting out of rental properties because credit investors, you don't want the debt in your own name. You certainly don't want the legal liability. So the question, my net worth is $1 million or greater. I'm a credit investor and I want to invest in syndications and private placements. I really need to have some sort of legal entity like an LLC.
Yeah, that's a great question. And yeah, because a lot of the deals that you're investing in, they're going to be in your own personal name. So like anything, if an asset that you own, whether it's 1% or 100% of it is in your name and you get sued, then that can be used to be collected on through a judgment. And so if you're investing in syndications or these more passive investment shares, you still want to protect them. And the way you do it is you assign your ownership into an LC, a holding company, or what I would use would be a limited partnership, which we use as a management company. And then you can hold your shares there. And it just goes to the principle of, what asset protection is. We're separating out ownership from legal use and enjoyment. You want to own your assets, just not in your personal name. That way, if you are getting sued, then we have legal room that we can use to protect the assets.
Maybe talk a little bit about the two ways you can get sued, the outside in, inside out, just so people can wrap their head around it, especially if they're new.
Yeah, absolutely. So there's personal liability. So outside liability, which is you driving your car and hitting somebody with your car. And then you're going to get sued personally from that. And then there's inside liability, which would be you own a rental property and then someone falls off the roof or there's a mold issue or fire on the property. And then they're going to that held inside an LC. Now they're going to try to sue the LC for their damages and collect from there. But most likely they'll try to pierce through that LC to get to the rest of your assets. Or if you're a business owner, it would be an internal lawsuit between, let's say, Lane and I own a business and the business is falling apart. And then we have to dissolve the business and sue each other. Liability, meaning inside the LC, inside the business framework. So in an ideal world, you want to protect yourself from both inside liability and outside liability. And the way you accomplish it is just through the use of creating business organizations like LLCs, limited partnerships, corporations, and asset protection trust. How we combine them just depends on the client's profile, what you have, where you're at, and we'll go through a risk profile and asset profile and see where you lie in that matrix.
And maybe you want to break it down, the difference between like direct ownership in rental properties and a mere limited partner where you're not the managing member. What would you say? It's hard to quantify, right? But would you say like one is 10 times as much liability or 150 times? Or
That'd be a lot more, because if you own something directly in your own personal name, there's no degree of barrier whatsoever between you and the person suing you. So you're the owner, the manager, it's all on you. Then if you are a managing member of an LC, this comes into this word that people talk about, charging order protections, and why you hear about Wyoming, Delaware, Nevada, Florida, Arizona of LLCs, because they have stronger charging order protections. And what a charging order protection is essentially saying is you're a managing member of this LLC, and we're going to limit how much liability goes directly to the managing member of that LLC. Some states have great charging order protections, the one I listed, some of them horrible. Basically, anyone that lives on the coastal areas, California, Oregon, Washington, New York. When we start getting like the Midwest, you'll have stronger charging order protections. But those will only go so far as if your veil gets pierced or not. So just realize something's better than nothing. So when you're starting with LLCs, get into some sort of charging order protection if you can. Depends on where the asset is at. So we can break that down again. I wouldn't recommend saying you're a California resident with a California rental property, go put in a Wyoming LLC. That's not going to work because you can't go buy another state's more beneficial laws, bring them to California, the state you're getting sued to. There's no jurisdictional connection. But you can do that with management companies because it's an actual business. So at the end of the day, we're trying to, again, separate out ownership from management. So you want your LLCs or your management company or your trust to own the assets. And you just want to be the managing member of that LC, because then you're going to get some charging order protection and limiting your liability.
So the way we structure our larger deals is myself as a general partner will create an LC, which is that first shell or thing to pierce. Most work the managing members. And then what I normally see is like the lawyers will probably put it in the state of Texas is typical what you're seeing, or is there any particular reason why Texas? And
I don't.
Sometimes I'll see like an LP entity use.
It's just more that you can do with limited partnerships than with LLCs. We don't really use Texas that much, so I'm surprised you guys are placing it in Texas, unless that's where you're buying. I don't know where you're buying.
Yeah. I mean, that's where all those
So
guys
then that's
are.
why it's no specific other reason than just you're buying in Texas. So they're using Texas as the jurisdiction, because if you get sued through that property, you're going to get sued through Texas law. So that's the reason for that. I personally like limited partnerships, not as a holding company. I use LLCs as the holding company in the state that you're at. So I would use that Texas LLC. But for the management company, I like to use limited partnerships as that management company, because there's just more that we can do with limited partnerships by statute that you just can't do by law with LLCs without trying to get really creative and crazy with operating agreements. And the problem is then you have to submit those operating agreements to a judge when you're getting sued, and it's up to judicial determination, meaning the judge will decide if he agrees with it or not. And anytime you're leaving something up to a judge and it's not supported by a statute in that state and case law, it's gambling. And in the world of asset protection, you just don't want to take gambles. And so that's one of the reasons why limited partnerships are just better as a management company versus using another LC to manage the assets.
So I guess for people listening, that's all taken care of you. But what some investors will choose is to bring their own holdings into that other parent LC or LP I personally see most people not doing that because they just quite frankly don't have enough assets for it to really make sense. But I think if you have a higher liability profession, certainly, or your net worth is higher than
right. So like for our clients, that's our starting point. And so that's why we're using those LPs as management companies, because then I can put in stock portfolios, cryptocurrencies, passive syndications, cash, bonds, intellectual properties. And then we can segregate out the risky assets into the LLCs below, and then have them flow into limited partnership for one tax filing. So it's out the assets legally and then creates one nice, easy tax flow. So you have one tax filing at the end of the year.
And also, as I'm seeing, I think the downside with this stuff is it can cost some money, right? This stuff ain't cheap. And I would also caveat saying that if you're sticker shocked by a 5-figure plus legal bill, you probably don't need to have this stuff because you don't have enough money, guys.
Correct.
But like I'm seeing it's a little bit of administrative using these things, because like now I'm having to make a bank account for this DLP and then run all my stuff through there, which I get in the long run. It's one kind of tracking method.
Well, when you think about it, it actually makes you adult up and increase your business IQ as well as your financial IQ, because the one way you're going to get destroyed if you get sued is through bad accounting, bad bookkeeping, not managing or commingling assets. And then you got to go hire forensic accountants who just, if you think the startup of $30,000 to create a very strong protection trust is sticker shock, wait till you have to go hire a professional forensic accountant for a trial. Like you just go bankrupt on that alone. And so that's where these systems, they come into play by cleaning you up. And a lot of people are like, oh, I don't want to use an accounting system or bookkeeping. You dot every I, cross every T, and that comes to your accounting, how you're managing your books. Like I'm not going to be managing your books for you, but you're going to have to get the bank accounts. You're going to have to get the organizations in place. You're going to have to then get a good CPA and manage your money so that if you ever do get sued, we already have all the documentation in place and you're shutting down legal arguments to pierce your veil.
Yeah. And that's why when I talk to especially the lower net worth investors, they always go through podcast land and listen to a whole bunch of stuff, which typically just like what do you call them? Like the legal marketers out there that just sell these kind of packages.
Legal promoters that just sell a bunch of junk like insurance. That's why I come in and talk on this stuff, is because like I have one of the top 50 trial lawyers in the nation. So I look at everything through case law and through trial and what actually works. Risking it for something just because you want to save a buck, or I don't want to pay $800 in franchise tax. I'm going to pick on California right now. And I get this a lot from California residents is, oh, I want to go create a Delaware statutory trust because I don't want to spend $800 in franchise tax. California doesn't recognize out-of-state asset protection trust, first of all. And if your sole motive is you don't want to pay $800 in franchise tax, you really are going about this a whole different way. You don't create asset protection structures based around saving on franchise tax. There's other ways to save on taxes. You need to think about, how do I protect my assets from losing them in lawsuits? Then work with your CPA and wealth managers to then use the tax code to accelerate your wealth legally.
And then going back to your earlier point, the pitfall with this stuff is these guys will buy this package and then they'll just not really manage it. appropriately because the person who sold it isn't really in the game of maintaining what they bought.
When a lot of them aren't
And-
even attorneys.
Yeah, and they mess
so-
it up. They mess it
Yeah.
up, and it's super easy to pierce their corporate veil.
Correct, because then they just throw it on you to manage, which it's not your job. You don't know how to do it, and then you're going to mismanage it. The other issue is a lot of times you're just not talking to lawyers. You're talking to what are they calling themselves now? It's like the modern day version of LegalZoom. They're not giving you legal advice. They're doing template work. If you do anything that's template and it's cheap, there's a reason it's cheap. So just think about that. Attorneys will cost more money, but you get what you pay for. And so what they're doing at these, I don't know, so like pimp shops, is just casting out a wide net like an insurance salesman and saying, hey, this works nationally. We'll create this for you at a cheaper rate. And that's all that you need. And you get this false sense of security. And then when you do get sued, you realize that LLC didn't work. Like I can't just go buy Wyoming law and bring it to another state. Why didn't that Wyoming LLC and a land trust work? The issue here now is when you hear people talking about series LLCs is not every state recognizes them. There's only a few, double handful that actually recognize series LLCs. Florida doesn't even recognize a series LLC, and you think that they would. So if you create a series LLC, which is creating a traditional LC and then subcategorizing out little children LLCs underneath them to try to spread out liability between assets, the issue is, again, not every state recognizes them. So if you live in Florida or you live in California or Oregon, Washington, basically like 70% of the states in the nation, and you get sued in that state and you went and created like a Texas series LC, well, a judge in the state like California is going to say, guess what? This is California. We don't recognize those. So this is just going to be treated like a traditional LC. So now everything is on the hook there. And there's not much case law on the series LLCs, especially in the states that even recognize them because they're new. They haven't been tested. So if it's new, it hasn't been tested. It's something that I'm not really going to use that much unless you live in that state and the assets in that state, and you don't plan on investing outside of the state. Then I would use it as a base layer. Remember, it's just the series LLCs, they're just LLCs. There's no difference. They're not stronger LLCs. They're just a limited liability company, allowing you then to break up assets and sub them out underneath as little children underneath the LLC. But your veil it's the same veil piercing arguments as any traditional LLC. There's nothing stronger about them.
I'll say this to be clear. Series LLC is another thing that's out there that's probably below the threshold of like the LLCs, land trust, series LLC. That's all kiddie stuff.
Don't go down the series LLC route. A lot of case law now is coming out on them. And even in states that have them, the courts aren't recognizing them as separate children's series. It was a great idea. We stopped using them about 3 years ago. So most of the good firms just stopped using them.
It's like creating separate LLCs for each asset.
No. So what it is, it creates a mother LLC. And then in that same LLC, like in Texas, then you can start creating sub-children LLCs underneath the mother LLC. And the idea is that you can space out separate risk into these children LLCs and they won't bleed over. But the issue is the parent LLC is still the main LLC. So judges are just saying, this is just one LLC at the end of the day. So I don't care if just the sub-child is getting sued. The mother is still controlling everything. What you do want to do is create separate LLCs for each asset and then have them owned and branched up into a limited partnership, a management company, because you're separating out risk. And that's how you do it properly. What they tried to do is be creative with these series LLCs, and the courts are just having nothing of it.
Lawyers are making the distinction between the omnibus bill doesn't pertain to fee simple land conservation easements. And I'm like, all right, I don't know if I agree with that, but
And you don't want to be the guinea pig. So I have some California clients who say, oh, I don't want to pay the franchise tax on these LLCs. So can we just have them all owned by these out-of-state LLCs owned by the limited partnership and not have to register them in California and pay the franchise tax? And we can make a legal argument for that. It hasn't been tried in California yet, so there's no case law. We could win, but do you want to be the guinea pig on that? Spend all the money when California comes after you and then potentially lose, or win, but be out all that money? It's just not worth the hassle to save $800.
yeah. And I think that's why people listen, because sometimes I'll guinea pig myself. I did this like equity stripping tactic at one time.
I remember you talking about that.
Yeah. I guess for people not familiar with this, you basically create like another LLC that's like outside your state and you put a lien on yourself. In theory, it sounds really clever, right? Because you've put yourself in front of the line in case you're in duress or litigation.
Judges hate it. It doesn't work.
Yeah. It's kind of like those land trusts too. Judges hate the land trusts, I hear.
With the land trust, the thing is there's no protection behind it. It's just a privacy mechanism. That's all it is. And so your protection comes from the LC that it's connected to. So again, you're just getting protection from the LC, privacy from the land trust, so your name's not on record, but you're still going to get sued. And unfortunately, all these legal promoters, air quotes here, talk about land trust and anonymous LLCs, like ghosting lawsuits, and they give these false perceptions that if I can just get a land trust so no one can ever discover me, or I'm going to get an anonymous LC and I never have to show up to a lawsuit and I'm just going to ghost a lawsuit. That's the farthest thing from the fact. Like all these setups have agents of service. Their sole job is to say, hey, Lane, guess what? You just got sued, man. You're served now. Go get your butt into court. And once you show up, your name's there. You're the managing member. Then the discovery process begins. You're going to have to disclose the assets that you own. And if you lie, then you go to jail. So the privacy mechanism is just so people can't harass you and find out where you personally live for harassment, for privacy purposes, not for ghosting lawsuit purposes.
And if people think that people can't steal your identity or not find you, I don't know what world you're living in.
And it's just common sense. You look up and, okay, who owned that asset last? Lane did. Who owns it now? A trust. I wonder who owns it. Lane's trust. It's just, you connect the dots. And then we have our own investigative agents who then go and dig through the records and figure this stuff out.
Yeah.
So yeah, if you think that you're just going to disappear off the record, you're insane.
In fact, it makes you look even more shady.
Legal optics are very important. So that's where you don't want to get in the world of hiding and not disclosing. I'd rather be fully out in the open, fully disclose every penny and asset that we have and say, we even own more, Your Honor. Like, here's everything that we own. Just have a setup so strong that it's not going to get pierced into. That's where those, in our world that I work in, the higher net worth side, that's where that bridge trust or those hybrid trusts come into play and saying, yeah, valid lawsuit, valid claim, we're going to lose, but my assets are still safe because they're out of the court order and jurisdiction of the US. So let's make a deal. Here's a penny on the dollar. Goodbye.
And this is what happens offline, and why I say dealing with real people, building relationships, just inner circle or family office, a HANA mastermind, if you guys want information. But we talk about a lot of these kind of designer trusts, and they're kind of like software in a way for some of you guys who are software salesmen. It's similar in the legal world, right? It's like intellectual property. That I don't want to say the term because I don't want to get sued, but the master dynasty East, whatever trust, right? There's all these terms for these effectively the same things, but tweaked, the computer code tweaked.
Yeah, like some people are now that left our affiliation, our firm, have now trying to knock off like our bridge trust and we tweaking it and naming it something else, but then they don't know how it actually works. So you got to be careful with that situation as well. So it's a hard maze to navigate when you're just neighborhood Joe or Nancy trying to protect your assets, and then you run into some smooth talking person. How do you know what questions to ask? How do you know to vet these people? How do you know what works or not? When you're trying to get through asset protection plan, you need to determine, do you want tax mitigation or do you want to protect your assets from lawsuits and creditors? And then from there, it's a matter of how much are you willing to brunt the risk for yourself? Like some people have a high risk tolerance. So like, I'm perfectly fine with an LLC and insurance. And some people are saying, I want to be as strongly protected as humanly possible. So that's a personal choice from there. And then from there, we have measurements. And I always say, use this acronym EC, effectiveness, cost, control, and compliance. Whenever you talk to anybody about the planning that they're going to create in place, you want it to be effective, meaning you don't want someone to say, it's just an LLC, this is $1 million lawsuit, we can pierce that veil. LLC's lowest man on the totem pole. They're not very effective. But costs, I don't think, should be the driving force of how strong your protection system should be. Depending on where your net worth lies, then the cost goes into it. If you can't afford it, you're not going to do it. So you got to be within the ballpark of where your net worth lies. So start with the LC and insurance, then go into the management company, then go into the very strong hybrid trust and asset protection trust road. You don't need to get it all in one day. So you have to be able to properly scale as you go. Compliance, you got to be able to comply with the IRS, which we're going to break down tax havens and stuff like that in a little bit. But you're going to be disclosing your assets. You're going to be paying taxes. It's just not paying your taxes goes to your CPA and your wealth managers. That's the tax code. Asset protection, completely different thing. And so this is the world that you want to look into, effectiveness, cost control, compliance. When you're going through your systems, the more you understand the law behind it, the more you're going to know when like a legal promoter is just selling you a bunch of BS.
I want to jump into the taxes here in a bit, but before we do that, I just wanted to go over, what we do similar under the same legal umbrella, but like with our syndications. A lot of people out there will just take the Word document template and just use it and not pay the lawyer
Yeah.
10, 15 grand. But I don't do that. I make them do it and fill out their own stupid template. But what I'm paying for is the compliance on the back end. Like, who's the lawyer who's going to come to bat when things happen?
When are you going to be there for me? So are you just creating the ghost template for me? And then what? Then am I on my own? Then I gotta go hunt somebody down? Or are you there for me when my world falls apart? That's part of why you have the annual fee, is saying, hey, we're here for you. Our team's here for you. I may not be representing you if you're getting sued for medical malpractice because you're a doctor and kill somebody on the table. We're going to go help. You're going to go find a medical malpractice defense attorney and work on that case. And we're going to be corresponding with you and your medical malpractice attorney while this whole thing gets resolved and works its way out. But then you need to make sure that the person who created the asset protection structure there for you is there for you when you actually need it to work, because you don't know how to do it. You don't understand how to utilize the back end portion of this. That's what our job is for.
And then I think that's the big thing for like lawyers or any profession, I think, that are more senior level, is their Rolodex.
When we've seen it so much, and that's where you get some people, like I was saying, try to knock off our hybrid trust, but then they've never actually had to use it when we've had to break the bridge. We've had to do it hundreds of times, but we have experience with it and the connections with it and when to tactically go about it. So someone, you can take a copy of my trust, you paid for it, and then go give it to somebody else and then start knocking off it as a template. But do you know how to actually use it? How do you know how to utilize the system when it's needed?
If I was a smart and unscrupulous businessman, I'd cross my fingers you didn't sue me. But when things do go awry, I would contract you with you to my client out of trouble after I white label your document. But anyway, moving on to taxes, we have some entrepreneurs who might laugh at that. But basic question that we get all the time. I need an entity so I can write off these business expenses. True or false?
I think that you should get a business entity, whether you're going to write the assets or whatever it is that you're writing off on it. That's going to go through your CPA and what is actually going to be deemed like a business expense or not. I don't think you're going to be able to say, I'm going to write everything in the world off on it.
Legal entities, such as what we're talking about here, are for legal protection.
Yeah.
Really nothing to do with taxes and being
It doesn't. So it'll help you in some because you're running it as a business, but it's not. It goes to the whole asset protection is not for tax purposes, which again, we'll break that down in a little bit. But you need to have the legal entities to separate yourself out from legal liability. When you start using the management company, you can probably start writing more stuff off, but that's just going to be a conversation that you're going to have with your CPA, and then making sure you don't commingle assets and you're not mixing personal assets from business purchase. Then you can start getting some tax benefits out of it from that aspect of it. But the two are separate, but they're kind of conjoined when we work with the CPA. So that's where it's that confusing mid-ground.
I think what's happening is some of these legal promoters, especially because their fees are super, super high, so they can take their marketing cut, they'll typically throw in a misleading line in there saying that if you don't have this LLC, the IRS will not recognize you as a business, and they'll audit you and they'll throw all your deductions and you'll go to jail.
And I think there's just like, we might as well just get into the whole like tax portion of it, because we keep tap-toeing around it here. And so like asset protection, like we're talking about, and like I'm saying, it's about limiting liability, right? From lawsuits and creditors, the people coming after you, trying to take your assets and your money from you. It's not about hiding or moving assets. It's not about avoiding disclosing your assets. What we really need to understand, and especially in the world that I work in, like the offshore Cook Islands Trust, offshore bank accounts, and then domesticating them in the US, for asset protection planning is not going to reduce your taxes. Creating business entities in itself is not going to just reduce your taxes. It's how your CPA files the taxes for how the IRS see you. If you want to change your taxes, change your facts, but you still have to disclose and report your assets and your income. And that's where a lot of these promoters are misleading people, like blatantly. And so if someone is telling you, this, it's just a complete scam. And this is why we don't use the Caymans or Belize or the Bahamas for trust and asset protections. They're red flagged. And there's a reason why they're cheap. It's basically the poor man's Cook Islands. So people who don't want to spend the $30,000 to create that Cook Islands trust will be like, I can create an offshore trust cheaper in the Caymans, Belize, or Bahamas, and they're telling me I can hide my assets and my income and not report them to the government and not pay taxes on it. The scam works by these promoters. Some of them are attorneys and some of them are CPAs, and they're trying to sell this idea that if you don't have your money in the US, then you don't have to pay or owe any taxes on it until you bring the money back to the US. And the fact is that the IRS taxes you on worldwide income, plain and simple. It doesn't matter where you earn your money. If you're a US citizen, you're a US taxpayer and you owe the taxes on it, you have to disclose it. The problem with this scam is that when the IRS takes a look at your plan, it's not going to protect you, but it's going to leave you with a massive tax bill plus the penalties. And if you can't pay that back and the penalties back, then you go to jail. The bottom line here is that asset protection planning and tax planning, they don't go together. Anyone promising you to help you, air quotes here, legally evade paying taxes using like any type of offshore entity or structure is almost certainly going to be lying to you. And if you're involved in a scheme like this, whether you just got duped into it or not, or you actually intended to do it, you're going to be the one on the line for it at the end of the day. The IRS are very clear on this, and you can actually go on the IRS website and they have a whole page dedicated to identifying what's called abusive trust tax evasion schemes. And so the IRS specifically lists trusts being used to reduce income taxes through abusive techniques that aren't allowed by the IRS code. And a few of these specific examples are underreported income, avoiding filing returns, failing to report overseas wiring income, attempting to protect transactions through bank secrecy laws in tax haven countries like the ones we listed, and more. So you can see this all sounds pretty. Don't report your taxes, don't report your assets, use these offshore entities, use these business entities, and don't pay your taxes until you bring the money back. Scam. The IRS are very clear on this. You're the one that's going to be responsible and liable for this. So I just avoid it completely.
Yeah, it is one of those things that is too good to be true. It probably is.
But the problem with like human nature is we constantly seek information to validate our thought process or what we want. And if you have 10 attorneys telling you no, and then you finally have the one that says, oh yeah, let's go and do it, I would question why that one out of the 10 said, yeah, let's go ahead and do it.
Yeah. So don't ask more than 2 people. Just kidding.
Right.
So what's the solution then for the guys what's the net worth range that you would typically say where this stuff makes sense? If not, good luck with LLCs and the common man entities.
Yeah, I'll break it down like this. So when you're just starting out, LLCs and insurance. Okay. And I look this as like you have 0 to 2 doors, 0 to 2 units. Your net worth is probably below 200,000 for you. Some people don't know what net worth means. So net worth, I'm looking non-exempt net worth, meaning the equity that you have. I'm taking your 401k out of the equation. They're protected through ERISA, taking your IRA out of the equation. So I'm looking at the equity in your personal home, your personal brokerage stock account, cash, equity in rental properties, syndication shares, vested corporate stocks. When we start adding all that together, that's your exposed net worth. So when your exposed net worth is below 250,000 and you have 0 to 2 units, LLC insurance is fine for you. When you get to the next level, which would be up to, I'd say about 650,000 exposed net worth, right there, you probably have around 4 units, 4 properties, maybe investing in a couple different states, or you probably have a high-risk profession as well, maybe like a doctor, lawyer, CPA. That's where that management company or that limited partnership come into play. We're starting to create that system now. You got the strong foundation, the LLCs at the base with insurance. Now we're getting a management company where you're doing better with your accounting now. We're filing one tax return. You're having good bookkeeping in place now. Now you can keep expanding and growing. When you hit around that 1 million mark is generally when we see people coming in. It's a sweet spot to where you should get this planning in place because it's taken you probably a long time to get to that exposed equity net worth. You probably have up to 4 to 6 properties or a commercial property or a large comp, maybe 10.
And I like the exposed net worth number. It's a little bit different. Like some people get fused because the SEC doesn't allow you to count your home, but your home is very exposed.
That's your personal name.
Yeah. But I like how you took out the 401k.
It depends on the state that you're in and where you set it up at. Some states like Texas will be exempt. Some states like California, like it's not very good. So then we can put that into the management company. So it really just depends on, again, what state that you're a resident of, because every state's going to have different exemptions and what they're exempting from lawsuits and not. And so that's where we really have to go through this like a fine-tooth comb and just throwing general stuff out and say, hey, here's this LLC everybody can use. It's not the smartest thing to do. Every state's a little bit different. That's the US Constitution right there. Full faith and credit clause. But then when you have
Say that you said 1 million of exposed assets, he's probably got $500,000, maybe even $1 million in his 401k retirement accounts between him and his spouse. So he's probably like a 2.5 million real net worth.
It could. Sometimes,
Yeah, yeah.
like I've been seeing more and more people that have completely rolled out of their 401ks and went pure 100% into real estate. And then I've seen some that are just pure into their personal stock and crypto. So it really just depends on what people choose to invest in, because some people like stocks, some people like crypto, some people like real estate, some people diversify out. Some people do global diversification in their investing as well. And really, I just look at what is the total value of exposed equity that you have? Where's it at? How's it titled? And then what's your risk profile from the assets that you own? And then let's see how strong of a system we need to create for you. And generally, a good starting point is when you hit that 1.2, 1.5 million. When I have clients coming in around 10 million and they've done nothing, that starting cost goes from like 30,000 to sometimes 45, because I have to create like 10 LLCs for them. There's just so much more work to do. It's a lot more expensive to do everything versus building it up over time.
So I guess I'll summarize. After a certain point, I think a lot of real estate investors, the house flipper types, are very do-it-yourselfers. They got their PowerPoint. I got my PowerPoint of like my entity structure, and you're like this LLC, that LLC. But after a certain point, million, 2 million plus, it's time to give up the reins and let your experts design it for you.
I
And then
said, do you go find your deals, close your deals, make your money, and then start adding the proper team members to your team who then do their jobs. Like you should have a person finding your deals for you. You should have a good CPA. You should have a good wealth manager, have a good protection attorney. Depending on the state that you're in, you may have to have a real estate attorney, because not everybody can do title closing and stuff like that. Sometimes it has to be done through an attorney. Your strengths, bring in the proper team members. When you have the proper team members working together, you have a beautiful system and you'll make more money at the end of the day.
so what is the difference between that guy who's few million net worth and the 10, $50 million net worth? How does it look a little bit different? Entity structure map look like what's
Actually,
added?
it doesn't. All they do is have most likely more LLCs at the foundation layer because they have more rental properties.
Okay. That feed into that LP LLC
Correct.
holding company.
Yeah. And then depending on what they invest in, they might be investing in different passive flow income. So their management company may hold a bunch like stocks, bonds, crypto. So they'll just be more diverse in what they're investing in. But the overall structure of the use of LLCs into the limited partnership with the asset protection trust, the hybrid trust owning it, that's the same system, whether you have 1 million or some of my clients hundreds of millions. It's still the same structure. It's just a matter of how much of the foundational pieces that we're actually using.
We talk about there's different forms of asset protection, and it goes up different levels. If you go back in the e-course, which I'm sure all you guys have done, good students, if you don't have very much money to lose, like under $1 million, all this is a waste of time because you're not a big target to getting sued. Certainly, if you're $500,000, $1 million net worth, you obviously want to be doing the LLC type of things and going down that direction. But there comes a point in time when that kiddie stuff just doesn't cut it, and you're like a higher liability doctor. People lives are at stake on your doing, even if you have malpractice and even if you are an employee of a hospital, you're just a bigger target. I think a lot of you guys here are to that scale where, as a friend, this is not legal, not tax advice, of course, but as a friend, I would highly suggest setting one of these things up. I'll lead in with everything you're not supposed to start off with when you're selling this stuff. It's not cheap. It's like maybe 20, 30, 40,000 to set one of these things up. But if you bat an eye, perhaps you don't have the net worth for it to be worthwhile. But if you've been sued once or twice, you probably are like, that mental stress is just, what's 20 grand to have this kind of extra protection on top of it. So the idea is like when you get to this level, you want to have irrevocable trust so that it's outside of your estate. So in theory, you are, if you want to sue me and you win the settlement, good luck collecting because it's not my money. You're maybe the beneficiary. And there's a whole bunch of technical ways that differentiate different irrevocable trusts, like a beneficiary, defector, grantor trust, or non-grantor trust, et cetera, right? We're not going to get into that minutia in particular today. We're just going to mainly talk about the bridge trust, which is a trademark term. And that's something you also have to understand, and it confuses everybody because it's meant to confuse you, is all these are marketable BS terms that are thrown around. Dynasty trusts, have your cake and eat it too trusts. They're all just cool names thrown around. And a lot of these are intellectual property. So think of like a computer program and some really smart lawyer, the PhD types, create these types of trusts and then license it to other attorneys to enact them for people and sit down with them and somewhat customize it for people. But essentially, intellectual property is licensed to these other lawyers. And sometimes you got to be careful if the person you're dealing with is not just like a legal promoter, doesn't even have a lawyer, doesn't even pass the bar, not even a lawyer. Essentially, so the problem with the irrevocable trust is like you put money into it and it's gone. You lose control over it. And that's what makes it's difficult. The cool thing about this bridge trust option is it's the best of both worlds. It's not irrevocable yet, but upon distress, if you lose a lawsuit, a substantial lawsuit, and I would say a substantial lawsuit would probably be 7 figures and above. In that event, they call it the bridge trust because if you think of a bridge, in duress, you blast the bridge and then the bridge goes away. Now you're banking out of the Swiss banks and it takes law from Cook Islands, Cayman Islands, etc. So if somebody wants to come after you, they're going to have to go to those jurisdictions, typically where those lawyers will not want to work on a retainer, like how they do in America. So I don't know. Okay, I'm not the lawyer right here, but it just blasts off to a different country, essentially, is what the thing does. But in theory, you never really do it because it's always just a huge leg up for you to just settle, right? What do they say? 99% of lawsuits get settled. You never litigate the dang things unless both sides are just hell bent on litigating. But unfortunately, you could be the very one who maybe ran over somebody's child and they just want to freaking come after you sue out of principle is what they say, which typically, it's hard to say, right? If you get sued by they have resources and funds to come after you, but they're typically pretty sophisticated. They're not going to blow money away. Normally, when you have those frivolous lawsuits is when, somebody unfortunately runs some kid over and they're emotionally charged and unsophisticated and their lawyer is taking them for a ride, their client. That's when these things could escalate unnecessarily. But this is exactly where you want to have essentially it's like the nuclear bomb. Like, all right, let's play this out, opposing attorney. If you win, who cares? You're not going to be able to collect. So would you like to settle right now for pennies on the dollar? So it's an extra way to kind of force that to happen. So that's probably what happened, 95% of the time, right? You show that you have this thing set up and 95% of lawyers will probably scratch their heads, be like, what? What is this? I've heard of this unicorn. So maybe that's a bad thing. Even the opposing attorney won't really understand what the heck this is. But if they were to get a referral from a better attorney, they'll start to realize, oh, shoot, we better just settle with this guy. Or I should advise my client accordingly to do. But let's just say it doesn't. It's some emotional, frivolous lawsuit and they just want to keep coming after you. Then you press the button and then you blast off and you start banking from the Swiss bank. One of the big questions that comes up is you can't really move stuff around after the fact, right? After a lawsuit gets filed or something is brewing. That is what's called a fraudulent conveyance. It's the F word. You cannot do this, right? You cannot move stuff around after the fact. This was not set up in response to this action. It was already set up and all we did was break the bridge. That's the legal argument. And that's how you're able to get the best of both worlds here. But yeah, there's a lot of, I think, black hat legal tactics where if you were to get sued, you just take your stuff and leave. And I'm sure it happens a lot, but that's where the fraudulent conveyance can be called upon you. And then now it's seen as really bad. The next level than just a lame holding company in Wyoming. I think a lot of you guys are just passive investors, so I get it. But I drive a bigger car and I spend 40 grand for that. I think this is cheaper for a different kind of safety in a way.
So what do you like about this over irrevocable trust?
Irrevocable trust, it's almost impossible to get the money in there and have usage over it. Now, some of you guys are in retirement mode and that can be okay. But if you're still trying to grow your net worth or operate an operating business, that's where I've ran into it's just not really possible. Talked about a little bit about irrevocable trusts and then the bridge trust. I explained is best of both worlds options. Maybe that's my first question is these guys, they've got their holding company where they might have some LLC stuff under it, maybe some rental properties in those. At what point do you think the irrevocable trust or bridge trust comes into the picture?
Most people think this is something when you have 20 million and a lot more assets. And it's actually the general client profile is 850 to 1.2 million. And generally you have 4 rental properties or maybe some sort of high risk professional on top of that, like a doctor or you're a pure real estate investor. So generally it's around 1 million with some rentals and some sort of risk profession.
Yeah, it's hard if you've never been sued before.
And it's not even a matter of if, but when. But the thing is, you got to go to your doctor. And then if you're a man, we got to get our prostate checked at a certain time. Or you got to go create your estate plan. You kick the can down the road. The thing that's horrible with asset protection, it just does not work if you don't create it up before the lawsuit. Because if you create it after the fact, it's straight up fraud. And so the courts are very strict with this. Sadly, like human nature, we don't do things until we feel the pain. And unfortunately, when you feel the pain, it means you're getting sued, which means you're in the middle of the lawsuit, which means it's after the fact, which means the laws won't work for you anymore. And so the only way, even with the big guns that we do, like the hybrid trust and the offshore Cook Island stuff, if you set it up after a lawsuit started, we're going to have to exempt the lawsuit. And then you're just going to realize that was an expensive learning lesson.
Yeah, so I talked to these guys about the fraudulent conveyance thing. I would imagine like opposing attorneys, like at what point in the process do you tip them off that you have this thing?
Right from the beginning. So you hear with a lot of other firms that do like lower level stuff, it's a lot of it is hiding assets, anonymity. Let's pretend we don't have things and create smoke screens. The problem is when you get drawn into court with that and you have to start disclosing stuff through discovery and litigation process, then they get pierced and then you look really bad. The optics look bad because you're trying to hide. With us, I'd rather have full disclosure right up front and say, yeah, we own all of that. We own even more than what you think that we have. Here's everything that we own, but here's our trust, and our trust has an offshore component to it in the Cook Islands. If you don't go away, I'll trigger it tomorrow. You can receive that $10 million judgment, but you're never going to get a penny out of it. So just goodbye, leave. So with us, as soon as you're telling us, hey, I got a demand letter, I'm getting sued, we'll talk to your defense attorney, whoever's defending you, see what's really going on. When we break the bridge is tactical, but we'll draft up a letter and tell the plaintiff straight up, hey, listen, maybe you have a valid claim, maybe not, maybe you win it 100%, maybe not. It's not a matter of that. It's a matter of, can you collect? We have an offshore component to our trust. If you don't leave and go away, I'll break the bridge tomorrow. You'll never receive a penny. And so we're very upfront with it, and we believe in not hiding, but just disclosing.
Yeah. And I'll say, I want you to help me verify this for me, Brian, but it's always funny that they always have is these make yourself invisible. This is, if you get subpoenaed for a lawsuit, you have to tell them there's no hiding.
No, exactly. And let me get here. And this is just straight up case law on this. And I don't know if you want me to like geek out and explain the case law on it, but it's lower level stuff. Their client profile is not geared towards higher net worth, high risk. They cast a wider net, which is use LLCs. Here's Wyoming LLCs and anonymity, but they're not dealing with the higher situation. It's good for the little things. It's not good for big lawsuits. And that just comes down to because anonymous Wyoming LLCs, you can't ghost a lawsuit, right? You can't disappear from the public record and just be like, okay, I'm good to go. You can't sue me. At the end of the day, the courts are really clear, and this is where I was trying to find on my notes, is that while LLCs like Wyoming, they can offer a degree of privacy. Privacy is good. I like privacy. Legal disclosure requirements always still apply. And this is really solidified in case law. Like we got Arbor Place LP versus Encore Opportunity Fund in 2002, Block versus Communications Incorporated versus Pounds in 2015, and In re Downey, In re Quack, and the list just goes on. So it's not a matter of ghosting a lawsuit. The only thing anonymity is good for is privacy to avoid harassment, right? Like people being like, Lane, you own my building. I hate you. I'm gonna harass you and stalk your family. It's good for privacy. Once you get sued,
like
your
your
LLC
coworker Google stalking you at
whatever,
work or something.
yeah, whatever it is. Like anonymity is just for privacy. But if you're going to get sued, they will sue your LLC. You will be served. Then you're going to show up in court, defend yourself. Discovery process begins, and then you have all the mandatory disclosures. There is no more privacy at that point in time. And so the only way privacy and anonymity works once you're in court is to lie under oath and commit perjury. So from that standpoint, we get privacy from limited partnerships and trusts. It just comes innately with it. So what we want is not to rely on privacy as the asset protection. Privacy does not equal protection. We need the system to actually work how it's designed to be effective and avoid people actually executing judgments on. Like, how do we adult with this? So you need both. And this is where people really get confused. They confuse, well, I got a trust. The trust is a trust. They lump it all into one thing. And trust is like ice cream. They come in lots of different flavors and types, and each one's used for different things. And so you need both an asset protection trust to protect your assets while we're living and getting sued. And then you also need the traditional estate plan, the revocable living trust. So you're going to need both of them, two different things. The way you connect them together is you have all the assets held under the asset protection plan, right? Like the bridge trust. And then you have your revocable living trust. We reference the revocable living trust in the asset protection plan. It's like adding a paragraph that says on your death and the death of the surviving spouse, all the assets will get distributed per whatever the instructions of the revocable living trust are.
Yeah, I'll highlight one thing. Like the living trust, that's just who watches my kids, who watches my dog, and my assets go here or there.
Yeah, just naming beneficiaries, you're doing your medical directives, you're doing your financial directives, but you're not owning or holding any assets in it. That's going to be in the asset protection structure.
Yeah. So trusts are good for directions and getting around probate, but it has nothing to do with asset protection. That's why, like, when I see people signing up with their syndications under their trust name, I think that's the most silliest thing.
And then here's the other one with trust is then you have like land trust also. Land trusts are only a privacy mechanism, right? So it's just wrapping around, it's not a shield. And so what you do is you connect land trust to LLCs, and that helps some people with avoiding transfer tax, and it gives you privacy, but it's only as strong as the LLCs that's the beneficiary. Then you have like other types of trust that you hear people talking about. Oh, Delaware's statutory trust. Those became popular maybe about 3.5, 4 years ago, especially in California, because what it is a tax mitigation strategy to avoid paying the $800 franchise tax for people in California. But it's not an actual asset protection plan. They're very limited. They're more expensive to even maintain than they're worth creating, and we can't put even all the assets in it. And it's not worth just trying to avoid paying $800. What happens if you lose your lawsuit? Then you get a max judgment of $1 million on you. Wow, I saved $800 that year. It's really worthless. Irrevocable, like gift trust and generational skipping trust, or irrevocable spousal trust. There's some variations of those even in Hawaii. The issue with those is they're really just estate tax deduction types of trust. They're not actually built around for asset protection. And so the goal of these is to decrease your taxable estate, but not to protect you from lawsuits. And with a lot of them, they're only for the beneficiary, not for yourself. And so most of these states, they're not self-settled either. They don't allow the self-settled legislation. So I don't know where you're all at, but think California, New York, Florida, Texas. Surprisingly, yes, I added Florida and Texas into that because they don't have self-settled spendthrift legislation, and you can't create them for yourself as your own beneficiary. So then the trusts don't work. So when we think of the world of trust, just realize there's lots and lots of different types of trust, just like ice cream. We have to always then make sure we pick the right one. And if our goal is to protect our assets from litigation and liability, those are asset protection trust. And then what kind of asset protection trust just depends on how strong we want the system to be.
At what point do you want to start considering a bridge trust?
Yeah, around 1 million of exposed equity. So that's the golden number is 1 million exposed equity. You have some sort of risk through your profession, and also most likely some real estate investments. And the reason it's around that $1 million threshold is because at that point in time, you're a target. You've outgrown just basic LLCs and management companies, and you've accumulated enough wealth to where one major lawsuit will wipe you out, but then you're probably old enough to where you're not going to be able to rebuild it back. And so we need to lock it down. What I find with the next level up around like 5 million to 8 million is if all the assets are in their name, the project is so big, they price themselves out of the market. For example, I've talked to some people. I was in Maui over the weekend and had 4 consultations, and surprisingly, all 4 of them were like this. I have 30 properties. All of them are in my personal name, and I have 30 million in cash. And what can you do for me? And it's okay. 30 properties all in your personal name means we're going to have to build a heck of a lot of LLCs for you on top of the management company, on top of the trust. So the project just becomes so big because they've done nothing. So you want to be able to create the foundation and the pieces, and then scale and grow with it as you grow. And then the next group above 20 million or more generally already have something. So I only have to tweak, maybe add the bridge trust or something like that. So 1 million exposed assets, risky profession, doctor, lawyer, CPA, real estate investor, and most likely you have, I would say, 4 properties under your belt.
Could you explain what exposed asset means?
Exposed means some things are exempt from lawsuits and some things aren't. A 401k is not exposed because it's protected, it's exempt under ERISA. IRAs are not exposed because most states have some sort of exemption around them. If you're in Florida and Texas, you have a homestead exemption. So your home's not exposed, it's protected. Let's say you're in like Hawaii or you're in California and you don't really have exemptions with the home. So then it's the equity that you have in your property. That's all exposed. Your personal stock account is exposed. Cryptocurrency is exposed. And crypto is a really interesting one because I get a lot of people with this misconception that they don't think that is actually an exposed asset. Oh, I got $1 million in crypto, I'm good. No, it's treated just like a stock, and you're going to have to disclose it and the keys and the wallet. And then that's going to be potentially subject to a claim. And you're going to have to potentially use those assets to pay somebody right in a judgment. So we got to protect the cryptocurrencies as well. Cash, syndication shares, if you own syndications. So those are all type of exposed assets.
Yeah, I would just go on ChatGPT and say, I'm in this state. How is my life insurance? Certain states, like they only cover up to 50 grand, for example.
It varies state by state. The only 2 good ones really, Texas and Florida. And then the rest is all going to be state by state, but it's generally going to be pretty low. A good trust, that's going to be a fully Cook Island trust. You're talking at minimum $35,000 just for the trust. And then generally $12,000 a year to maintain that trust, because then you're going to have all the mandatory disclosures, right? 1035s, 1035As, full trust disclosures. You're not going to be in control of the trust. So it's way overkill for most people, and you don't need that type of expense unless you have insanely high exposure, some sort of movie star or professional athlete, or you have so much real estate that you're a big target. Then it probably makes sense. Let's just be offshore. Most people aren't like that. We need that strength because you have a lot of risk and liability, but wouldn't need to pay for it all up front. So that's where the hybrid comes in, is let's create the Cook Islands Trust. And then under the IRS code section 7701, they say, hey, look, we know that you have this Cook Island Trust. We can care less. Good for you. Congratulations. To make your life easy, as long as we name you as the trustee in a state in the US as a site, as the location, we'll just consider it as a domestic trust. And that's how the bridge trust works. It's a fully registered Cook Island trust, and it's domesticated by having the IRS just classify it as a domestic trust. Breaking the bridge just means I'm no longer going to comply with the code section. Doomsday lawsuit happens. We're removing you as the main trustee. And now the foreign Cook Island trustee pops into play to protect the assets. And it's not a one-way street. We can always add you back, but the upfront cost is cheaper.
Alternatives to bridge trusts.
Realistically, it just depends on how strong you want the system. If you want something that's going to work, there are none. You can create domestic trusts, right? Domestic asset protection trust. The problem with purely domestic US-based asset protection trusts is they just don't work. We tried it. They came into effect about 10 years after the Cook Islands. We brought in the South Pack from the Cook Islands, and they started helping us create our statutes and self-settled Spencer legislations. And then sadly, in the early 2000s, the case law was just horrible. We have Bailey versus Mortensen, In re Hubbard, Kilker versus Steelman, Dell versus Dell, Tony One versus Wacker. And those are just really good cases. They should not have lost these cases. Good facts. Every single one of them, the courts pierced through them. They didn't recognize the choice of law clauses. And then based on public policy, which is just up to a judge's whim, they pierce through the trust. And pierced trust means complete loss and failure of the assets inside the trust. Are they cheaper? Yes. Domestic trusts are cheaper. Do you have to do any of the disclosures? No, you don't have to do the disclosures. Are they effective? they're not effective. So you're just wasting a lot of money on something. At the end of the day, if it gets challenged, it's not going to work. And these are even clients in cases where they were residents of the state where the statutes were in. Like, it's one thing, like even to where there's this case, Kilker versus Steelman in 2012. This was about a California resident who created a Nevada asset protection trust. And this was pretty common. And sadly, it still is common with people who don't understand this area of law.
Yeah, I mean, this is something that I considered back
No,
in
like
the day.
legitly, yeah.
Yeah, because I
And
don't think I can get one in. I think Hawaii does, but we were looking at like a Nevada one. But yeah, this is what a lot
Yeah.
of people will do when they're looking for the cheap option.
they're looking for the cheap option, and they're looking for something because they're like, oh, I can get some protection out of it. But here, this is what you run into. So what happened in this case was Kilker was a contractor who did pools, and it created a Nevada, he was a California resident, created a Nevada asset protection trust because a lot of these states don't have self-settled spendthrift legislation. They don't have it. You can't create one. So they're like, all right, I can go to Wyoming, or I can go to Delaware, or I can go to Nevada. Most run off to Nevada because Nevada is just the best if you're talking about domestic. And then they got sued 5 years later. So he created it without a lawsuit, right? Got sued 5 years later. And then the California court said, listen, we're tired of you California residents running off to another state and creating an out-of-state asset protection trust. We don't recognize them. We don't recognize out-of-state asset protection trust. And we're going to pierce it, and we're not recognizing them. We don't have self-settled spendthrift legislation. And we're creating a 10-year look-back period on top of it. So they changed the law and added 10 years as a look-back period. You can't use something that, like another state's more beneficial laws, and bring them to your state that don't have them, that don't recognize them. And then you have other cases like Bailey versus Mortensen, where, like it's like an Alaskan case, an Alaskan self-settled spendthrift legislation. So Alaskan resident using an Alaskan case, and the trust was pierced based off of public policy reasons. So even in that situation, they're not working. The same thing with 21 versus Wacker and others. So what options work? It just depends on how strong do you want the system to be. If you want it to work, it's the bridge trust or purely foreign. I would never really recommend purely foreign because the better option is just to hybrid it out, pay less in upfront cost and then less in maintenance fee. And then we still have the strength in the back pocket. Other things that might work for little things, scale into it, right? Get an LLC, get insurance, get an umbrella policy, then scale into it, add the management company like a limited partnership. And then as you grow and scale and accumulate assets and more risk, and your big red button keeps expanding and growing, then you add the trust on top of it. So it's not like you have to do all of this at one shot. Look at where are we at now and where are we going in the future? And then we can scale into it at the same time.
If the options for asset protections are so weak, then, because Elaine was saying that like the bridge trust is not really used widely.
Yeah, it's a great question.
I think because it costs more than $1,000.
That's partly it. And we're not taught this in law school. We're not taught this. It's not a requirement for the bar exam. Most law firms are businesses. Businesses need to make money and run a profit line, right? So most firms do not specialize in asset protection. Most are estate planners, business attorneys, real estate attorneys. They start dabbling into asset protection. What does that mean? They take a continuing legal education course and then say, oh, hey, a client can use an LLC. Let's use an LLC in insurance. Like, for example, their client profile is generally 500,000 or less who need like an LLC, maybe a management company, and they don't tip their toe in the world of asset protection trust. It's not what they want to work in because it starts narrowing down the amount of people that they can bring in. Most firms that do try to do it, they try to cast a wider net, just like insurance businesses. So there's a small amount of us that work at the top end with these offshore trusts.
Yeah, and not to say that they're bad or anything like that, but again, it's like their clientele, that's
No,
good
sure.
enough for them. My original statement, again, I'm not a lawyer, but I previously said, Brian, well, 5 mil, general rule of thumb. But then again, yeah, if you're between 1 or 2 million, you get a lawsuit. All lawsuits are going to cost $250,000 to fight it at least. And then if you lose $500,000 at least, like now you're at square one. And how much pain is it to replace it?
And more people are self-funding their own retirements now. This wasn't normal. And so you're having more and more people who self-generated $1 million, and it's not just in the stock market. Now it's real estate. Real estate investment adds risk. Again, it's a knowledge gap. It's business profiles and the clients they work with need the base layer, LLCs, insurance, and tax help. But then once you get past that stage and you outgrow it, that's where these bigger tools come into play. But not everybody's going to have that knowledge. It's just, okay, there's doctors. Why is not everybody a brain surgeon? There's a smaller amount of brain surgeons than there are general family practitioners. That's why they refer them off to someone who's a specialist. I was a trial lawyer in the beginning for a long time, and I was one of the top trial lawyers in the nation. And I also like money, investing. I like looking at taxes. And I just got really tired of seeing clients being sued fraudulently and the system just run on them to get payments and their lives just being deteriorated and the stress that came out of it. And then Lane was saying tens and even hundreds of $1,000s they had to pay to defend themselves and then just had the case dismissed for no reason. Then they have no recourse after that. So I started looking at this and being like, man, our legal system is so messed up and our banking and financial system is so messed up. What can we do to get ahead of this? And so I started researching and I started affiliating with the top 2 firms in the nation that did this. And as I started learning about this, I realized the 2 options are either you go purely foreign, or then there was when I ran into Doug Lodmell, who created the hybrid trust 30 years ago. I was like, what would I as a trial lawyer not want to go up against? And then that's what you don't want to go up against, like the Cook Island Foreign Trust and the hybrid option. Because even if I win, I lose, I can't collect. And then I just spend X amount of $100,000 and then my law firm goes broke. And now I take my shingle off the door and I have to go work for somebody else. And then like anything, why I specifically started using the bridge trust was because I didn't want to sell false sense of hope to people.
And then a layer on top of that, like we mentioned earlier, is the Domestic Asset Protection Trust, the DAPS for short. Well, how much are those, Brian? People are charging, what, 5, 15 grand?
Yeah,
for
it
that?
depends. You see it on average between 6,500 to 11,000 around there. But I guess, again, the issue with the domestic is you can't outrun the U.S. Constitution, can't outrun the full faith and credit clause. So what that means is the foundation and backbone of asset protection is what? Not recognizing a judgment. End of story. We just want to not recognize it. Yeah, you got a $10 million judgment on me. Put it in the trash. Who cares? The hallmark of our legal system in the U.S. is the Constitution, the full faith and credit clause, Article 4, Section 1, which means a Nevada state can't ignore a California judgment. They have to execute and give it full faith and judgment. Whereas you take it to like the Cook Islands, they're just going to throw it in the trash. You have statutory non-recognition. We don't recognize that. You got to sue it down here in the Cook Islands. That's why the domestic asset protection structures or anything purely domestic generally always fails. And then you add on top of that, the superpower of a judge's public policy power.
The drawback to having just a large umbrella insurance policy.
Yeah, insurance policies don't pay out for fraud and allegations of fraud. And in the modern day, like in the last at least 15 years, I've never seen a civil lawsuit that doesn't have some sort of allegation of fraud or intentional wrongdoing. And then a lot of times now we're getting claims above the claim limit, right? So if you have a $1 million policy and you get sued for $2 million, like where's the extra million going to come from? We had a client who's a California doctor and he got sued for $4 million for a medical malpractice issue. And he had $2 million in medical malpractice and then a $2 million umbrella policy on top of it. Medical malpractice covered their $2 million. The umbrella policy company provider was saying, all right, we'll cover the other $2 million. Then the umbrella policy provider countersued the doctor after and said, hey, you know what? We want the money back. We think you should have gotten coverage on top of the umbrella policy. So we want the money back.
Wow.
So thank God we had this bridge trust in place, but that's the issue with insurance. Insurance is good. Get insurance. Right? Insurance is not asset protection. Pre-planning, having an LLC. And then it's what happens when the insurance doesn't want to pay out the claims. It's good when like the pizza man breaks his leg, right? But it's really bad when you're getting sued for $1 million and the insurance company doesn't want to pay out. And then I had another call the other day who the reason this guy called was he ended up getting a fender bender and showed me the picture of it where it's just a scratch on the car, like going 2 miles an hour. And then this person was so predatory that it hired an attorney to then sue him for $1 million. And then thank God the defense attorney was able to settle it for $40,000. And then he had to fight $1 million lawsuit.
That's crazy.
I have another story here. This is pretty recent. I was talking to an investor and they were getting an inheritance and they were sharing it with their 3 siblings. There's an asset worth a couple million and it had an elevator in it. And then the elevator broke and some people were injured, died, and each human life is typically $1 million. So several $1,000,000 here. But the worst thing was it went after all the siblings that were on title now. So the possibility of reclaiming was maybe 3x because it had 3 people that to go after. So obviously that's a real sweet, juicy case for an attorney to get. So I just say that because multiple people could be injured or hurt. And then also just a fair warning that this is why just liquidate these assets when you sell so you don't encumber your kids with these problems later on.
You guys got really good questions.
So for books that have an existing LLC structure for real estate assets, you would maintain those underneath the
Yeah.
for the
Yeah, you keep those because we don't want to then take apart the LLCs and to build new LLCs. What we do is just integrate them into the planning. So if you're like, hey, I'm at the stage where all I have are LLCs. What we do is then take them out of your personal name, integrate them into the limited partnership, and then clean you up from a tax perspective. Just one tax filing now. It's 1K1 issued to you. And then the trust owns the limited partnership. And I don't know if you guys were able to touch upon this before I jumped on, but a lot of questions like, why a limited partnership? Is a great question. Why not like a Wyoming LLC? And the reason is that limited partnerships are the next level up in the realms of business structures. LLCs are like the low man on the totem pole. Limited partnerships are really good at a couple of things. The first one is you can only create a limited partnership by separating out 2 classes of ownership, the GP and the LP, right? So I always think of it like you draw a circle, you draw a line down the middle, and I call it like a schizophrenic, like a bipolar personality, right? On the left side of the brain is going to be the GP. That's going to be you, the managing member. And then the left side or the right side is going to be the LP. That's what actually owns the limited partnership. So you have a clear distinction and delineation between managing member and ownership. You cannot do that with an LLC without getting really crazy with operating agreements. But you can do that with LPs by statute. There is no other way to create a limited partnership but that way. And so when you start getting crazy with LLC operating agreements, the problem is when you get sued, you got to present them in front of a judge, and a judge will determine if he agrees with your operating agreement or not. And 9.9 out of 10, if you start getting crazy like that with operating agreements and try to create them like corporations or try to create them like LPs, the judge is going to say, you're using the wrong entity. You should have used that entity then. Your LLC is pierced. And so that's one of the big reasons why. And then the other one is it gives us, besides that clear delineation, do get built-in privacy. I like Arizona limited partnerships, which gives you an exclusive charging order protection. And then it gives us somewhere to add the trust on top of it, right? Like I don't want a linear line straight from I'm the owner manager to my trust. And so we want to separate out management from ownership. My trust owns the limited partnership. And then I'm the creator and beneficiary and settler of my trust.
Gotcha. So I may have missed this because I was a little late dialing in it. Can you just recap what happens when you invoke the foreign, if there is a lawsuit and you take this over the Cook Islands or wherever?
Yeah.
Do you still have control of the assets or what's the deal?
That's a great question. So you have control while it's domesticated, right? That's one of the benefits of it being a hybrid is unlike this is what people also don't realize. Unlike domestic trust, you're still out of control. You still have to be out of control. Purely foreign, you have to be out of control. The hybrid, it's self-settled. You maintain control. Once we break that bridge, what breaking the bridge means is I'm no longer complying with IRS section 7701. That's a control test, court test. That's the one that says, Eric, we're naming you as the trustee and we're naming like whatever state we like. We'll just use Nevada as the state for the trust. What breaking the bridge means is I'm removing you as the main trustee because now we're no longer complying with that code section. So now we are purely foreign. So once we break the bridge, are you in control? No. We don't want you to be in control because if you're in control, a judge has control over you. So we want to be purely foreign at that point in time because I want the offshore trustee to be able to tell the judge, you have no control over me, the assets are safe, and you can't hold Eric in civil contempt of court because of it. And that's a Supreme Court case, U.S. versus Grant. And in that case, they tried to go after the wife 3 times. The husband stiffed the IRS for like $26 million, had a heart attack and died, put it in the Cook Island Trust. And then they tried coming after her and she won, but then didn't settle the case. And then she kept taking out like $250,000 a pop and giving them to her kid. And then it kept opening the door for the IRS to come back after her and saying, you're obviously in control of this trust. You keep taking money out of the trust. You're not settling the case and you're giving it to your children. And so they kept coming after her and trying to hold her in civil contempt of court. But even in a dumb situation like this, where she wouldn't settle and kept coming into the trust and taking out huge amounts of money at a time, they still couldn't hold her in civil contempt of court because the offshore trustee was still in play. Settle the case and don't take out large amounts of money until the case goes away.
So who normally is the offshore trustee?
Yeah, it's not while it's irrevocable. The trust is always irrevocable. Right? It's always an irrevocable trust. You're only out of control when the bridge breaks, when we're going offshore and the offshore trustee steps in. The offshore trustee at that point in time, we always use South Pacific. South Pacific is the very first creator of the very first asset protection trust in 1984. And then they're the same group that the US brought over to help create our sections. So they're the gold standard. They're the best. We just use them, stick with them. Don't find someone who has created a LLC 3 months ago and thinking you're going to save a buck and use them and then they disappear. Use really solid offshore trust protectors. And then the trust protector, you're only out of control while we have to be foreign, right? Like once the lawsuit goes away, there's no more duress. So there's no reason for you to be out of control of the trust. So we just rename you as the trustee. Richard is removed. Offshore trustee who's on reserve comes in, big shield, settle the case goes away, no longer duress. Richard's put back in as the main trustee. You're always the beneficiary and creator.
But you don't have to worry about a holding order that's perpetual. Once it's settled, then you can bring it back.
The way litigation plays out is this gives you the ultimate negotiating chip because the money can just sit there safe. And they probably just spent God knows how much money to try to get that far in a case. The likelihood of that happening is small because they would have to sue you down the Cook Islands and start the case all over from scratch, get there before the 1 year statute of limitations, plus prove their case beyond a reasonable doubt, plus front the court costs, fly in a judge from New Zealand, and find an attorney down there. So the whole system is staged for them to lose. Just because they got a judgment against you, it's worthless. It's not going to work. And that gives you the leverage to literally how these cases play out is we'll give you a penny on the dollar goodbye. And that's how this settles out. And that was how the famous Anderson case even settled out. They were criminals who created a Ponzi scheme, got criminally charged, were convicted, and then they went after the money in the Cook Islands that they stuffed it in. Don't do criminal Ponzi schemes. I'm not saying for a teaching point on that, but they were able to settle the case for 5 cents on the dollar.
I think earlier you guys have a good question there because it's all right. In a way, I'm going into witness protection and I can't talk to my mom anymore.
Yeah, but you're still living your life. It's not, oh my God, how do I live? Like, how do I buy groceries? The offshore trustee pays the credit card, pays the bills. You go into Starbucks, you're going to go live your normal life. The only difference is I wouldn't say, hey, go buy this $1 million property. The mindset shifts when you're getting sued and in big lawsuits. It goes to, we have to defend the lawsuit and we have to protect the assets. So some things are going to go in pause. And then once the lawsuit goes away, you go back to deploying your assets and back into investing.
Yes. How have you seen this play out, Brian? So people go abroad, they live off of their overseas account. And then like some folks on your team said a lot of people, they enjoy just not having a US bank account and they just go like that. Right?
No, you can. Yeah. It's not a one-way street. You would think you wouldn't want to pay the $10,000, $12,000 a year. I'm surprised myself. It's just what the statistics of it shows because over the decades, we have over 3,000 clients. We have had to break the bridge over 300 times. So we have had to fight this and use this in court 300 times. And
do you have a party for those guys or any kind of cool event for them? That'd be a cool gathering.
The bridge breaking convention.
Yeah.
But to my surprise, a high majority of them, like they say, like they just, it's an easier system. They enjoy it. And I think they just sleep easier at night and they got used to using it that way. Doesn't mean you have to. We have other ones that are like, okay, hey, put me back on as the main trustee and go about how things were beforehand. So it's not a one-way street. They find it easier and simpler to use once the bridge is broken.
Yeah, a lot of these guys, they got guns. So that's a checkbox there. And then they have their crypto. They have distrust in the government. And that's just how a lot of people are in that world.
Yeah, well, in general, I think I don't preach to like conspiracy theories. I just look at the system, how it actually is. And especially a couple good books on it is like The Sovereign Individual and The Creature from Jekyll Island. And it really shows in the first one is the sovereign individual isn't about giving up your citizenship. It's just about in the information era of society, we become globalized. And now we have bankrupt systems and corrupt governments and trying to redistribute wealth. And they don't hide it even anymore. And so how do we, as we're accumulating more and we have this bigger target on our back and we're living in this Robin Hood economic system, and we become globalized, how do we protect ourselves now? And we already know purely domestic issues aren't going to help. The only option of that really is to create this hybrid system and layer it out. LLCs for risky assets, management companies, and then the big guns, if you're at that $1 million or more spot, to where, God forbid, like the system turns on me or another administration comes into office and things start going haywire, or we have more banks going down. Like, what do we do? I already have the system in place. And it goes to more ability to have like cross-border protection.
I think that's what's cool is like, you know who your service providers and then they show up when it's not a huge company. Some people may not like that, but I think especially when you get into trouble, you want to talk to the guy who sold
Like,
you.
and I know Doug's the same way. We try to be very accessible to clients and to people. It's like we run a concierge service. And part of that maintenance fee with people is availability and access without receiving a bill in the mail for it.
Last question. You mentioned the trust creator a couple times. Does that matter who the creator is?
It's always going to be you because you're the one creating it.
Yeah, but I guess you just call it out as a separate thing.
Because when you're breaking down like who's what, there's the testator, which is like creator, you. There's the trustee, which generally is going to be you, or it could be an offshore trustee. And then there's the beneficiary of it. And so when it comes to an asset protection trust, it's self-settled. So you're all three of them. I'm the creator of it. I'm also the trustee of it, which gives me control to manage my assets on my own terms without an offshore trustee. And then I'm the beneficiary of it. And so that's what makes it self-settled. Other trusts, which we start seeing, okay, what's the problem with domestic? One of them is I have to be out of control of it and subject to my own third-party trustee. What's the problem with the foreign trust? I have to be subject and out of control of it to the offshore trustee. What's the problem with New York spousal trust? The beneficiary issue. Same thing with Texas and Florida. Can't be named beneficiary, can't be self-settled. So these are where you start getting the issues with different types of trusts and different regulations in different states. So you always have to have a creator, you're always going to have a trustee, and you're always going to have a beneficiary. Then it's a matter of who's the trustee, who's the beneficiary.
Yeah. If anybody's getting sued, it's too late.
Yeah, I harp on this a lot. And I always love these calls where I listen to everything that you've talked about and I need you to create an asset protection plan for me. I'm getting sued right now. And then you didn't listen very well. And we need to work on reading comprehension skills, or I wrote my book really bad. But no, it has to be done before the lawsuit, right? It's just, I don't have insurance on my house and my house caught on fire. I'm going to go get insurance on my house. That's not happening. I don't have insurance on my car. I got in a car wreck. I'm going to go get car insurance to cover the car accident. That's not happening. Asset protection is the same way because that's the definition of fraud, right? Is transferring assets to hinder or delay a creditor. And it goes one step further. It's just not in an existing lawsuit. The true definition goes to like it was foreseeable that I'm going to get sued. When I was doing most of my trial work, we would wait till the last week of the statute of limitations before we file our complaint because we want to see how bad things are going to get. And it generally jacks up damage costs. That could be a year or two, right? But I knew within that whole amount of time, it's foreseeable I'm going to get sued, right? So what generally happens is I hit somebody with my car, not going to get sued right away. I get sued a year later. A judge is going to say, Ron, we knew you knew it was foreseeable. You were going to get sued because you hit that person with your car. What you did was change the character of the assets and you hid it in that property, undo what you did and give them access to it. And so that's why you have to create your defenses, right? Before you're getting sued. It's just like you don't build a castle in the middle of a war. We build our castles and our moats and our drawbridges and our outer defenses when it's at peace. And that way, if someone wants to attack the castle, we have all of our defenses in play now.
Just reach out to Brian or we can connect you guys. But thanks for jumping on, everybody. If you guys want to talk offline, get my other input on setting these things up. I've done all kinds of things like this equity stripping BS that didn't work. That was 15 grand. I did another one that was 30 grand. So I've spent a lot of money doing it the wrong way. But yeah, I know it's a lot of money, but when you get sued or even if you hit somebody with a car, you're going to wish. Of course, always do things non-fraudulent and you do things right. We don't live in that world, unfortunately.
Yeah, no, like you don't rise to the level of your income, you fall to the level of your protection system. And
I
like,
like Brian, like my last question here is one problem I see with this thing is it's advanced, right? Don't you get a lot of these like attorneys that take the client for a spin and say, oh yeah, we can fight this. What I'm talking about is like, it's funny. Like a lot of people these days, when they work for a company, they get like free legal services, right? But they're like the
yeah.
shittiest of attorneys that don't have any jobs. So they sign up for this, pay a $50 deductible and then review some stuff. But you get these guys who will tell their clients, yeah, we got a case here. He hit your car. Let's go and get him. But they don't even understand. These are like the worst of the worst attorneys.
I would just, that would be your defense attorney. And then we would just send a letter to them. And most of them are just trying to like get a quick settlement out of 20, 40,000. It's not worth breaking the bridge for small potatoes like that, but we can still threaten them and they'll get scared and go away. It doesn't mean that we won't do what we're supposed to do. Would I break the bridge for it? No, I would talk you out of it. It's not worth it. And your defense attorney should be able to get that settled pretty quick for you.
Hey, Brian. So what if you went through and did all the previous things like the Series LLC, the Wyoming company? Can you reuse all of that? Or you have to-
I can reuse like the series, like you have a series LLC. I can just integrate that into the limited partnership because to be honest, the protection doesn't come from the lower level. Like you can have any type of weird LLC. It comes from the interplay of the limited partnership and the trust and how they play off of each other. I have people come to me with jacked up LLCs that they self-created and use some templates online and did them themselves. Honestly, it's not really the protection coming from the LLCs. It's the other the higher levels. So we would just remove you as managing member of it and then put it into the limited partnership and go from there. And then you may not need the Wyoming LLC. Just dissolve it. Save yourself the headache of the cost.
That's what I did because you got all your bank accounts all set up. You got your QuickBooks all set up, right?
Yeah.
You don't mean to mess that up. Okay. All right, everybody. Before somebody has another question.
So I think we run up to the end here.
When you do your consultations, be prepared to treat it like a medical doctor. I'm your legal doctor. The consultation is when you get on my calendar and we talk about your problems. Be prepared. Know what you own, how you own it, and your title so that the consultations go smooth. And any attorney that you're going to talk to is probably not going to have the conversation very long if you're not prepared for the consultation. So just keep that in mind.
I would say for you guys, like there's a nice template that we use because all my bankers use that when we underwrite loans. It's the personal financial sheet. We call it the PFS. If you guys want to get access to that, make sure you guys join the club so we know who the heck you guys are. We don't work with strangers out there, but go to up there and then just email the team. We can and ask for the PFS, personal financial sheet, one of those universal sheets that you put all your assets, liabilities, your cash flow. It's basically your income statement and your balance sheet all in one nifty Excel Google document, so that when you do hop on a call with a professional, you look like you know your stuff. Thanks, Brian. We'll see you guys next time.